analysis. One of the quite useful tool for the finance managers to make sure the wealth of the shareholders are increased is the financial statement analysis. We have done the financial statement analysis course separately, I think in our accounting class or the financial statement analysis class. But here the objective of the course is slightly different, right? The objective of the financial statement analysis is different for corporate finance, is different from financial analysis, because here again the major objective is to evaluate every spend and everything as to see whether this is increasing the shareholders wealth or not. Not just only for operational understanding or for ensuring that the revenue is why revenue is higher or the expenses are well managed or resources are well managed. The objective here is mostly on to look at the what the whether the investment or whether the our activities are increasing our shareholders wealth. So since we have already covered major aspect of this in other class, we will be just looking at the overview of these things, right? So the financial statements is usually is an accounting report which is issued periodically, and it represents the past performance of the company. Past performance is done by the profit and loss statement and a snapshot of the assets and the financing of those assets through the balance sheet. So usually there are three statements which are generated, which is called, one is called balance sheet, which is the snapshot of the firm's assets and how the assets are financed, whether the financing is coming from. Then you have the operation performance report, which is the income statement, which usually carries out the detail of how much the company has earned, how much they have, where they have spent the money, and what is the net result of that activities, right? And the cash flow is practically just only about the cash, because the income statement includes non-cash items. The cash flow statement is going to tell us how much cash the company has generated during the year, how they have used it, and if they have borrowed any money or not, if they have raised any cash from outside or not. So these are the three major statements that we normally analyze. And investor, usually the investor, financial analyst, manager, and other interested parties are the users of these three financial statements to make their decision about the company, right? So that they can get the details. Usually the public listed companies are also required to submit their these three financial statements together with the auditor's report, director's report, and other type of reports to the stock exchange. So I think we have discussed earlier as well on the director's report when we were looking at the course and we looked at the listed companies financial statements. So usually they have different form. Every country has different format of annual basis. So in US it's called 10K and 10Q. You have looked at 10K in the past when we did another course on the financial statement analysis. 10Q is just summarized form of 10K, but and is quarterly, not for a whole year. 10K is for the whole year. So the annual report has to be sent to shareholders every year. Nowadays, some companies are discontinuing sending the annual financial reports in paper format. They are sending it by only the digital formats anymore, no more paper formats. So what is balance sheet? The balance sheet is also called the statement of financial position, and it lists all the firm's assets and liabilities. It provides a snapshot of the firm's financial position at a given point in time. So it's always at a given point of time. So it's always either on some date. So usually it's either the calendar year end, i.e. December 31st December 2000 and let's say 20, or on a quarter end. So let's say 31st March 2020, 30th June 2020, 31st of October 2020, or something like that. And normally it's coincide with the calendar year of the country, how they have to submit the returns, right? Tax returns, or the financial year of the company which they have decided. So the financial year of the company may be not necessarily same as the tax year of the company or the calendar year. It can be different. Many countries are following calendar year, i.e. January to December, but certain countries follow financial year, which is usually April to March. Certain countries follow separate. Maybe they are following October to September. For example, in Myanmar is October to September. So different countries follow different methods, and usually the financial statement from the companies are also following the same calendar year as the government. So it's an example of there is an example of this company's balance sheet as of 2016. So here is the two part of the balance sheet. Usually one part is called assets and the other part is called liabilities. So the very important thing that you have to understand is the totals of both sides has to be same. If it's not the same, it means the balance sheet is not correct. Today's softwares are normally does not allow any transaction which is not balanced. So it usually always balanced, but in case it's not balanced, then it's not correct. So thus on the one side, when there are assets, the assets are also divided into two parts. One is the current assets, i.e. those assets which are going to be realized into monetary level within 12 months from the date of the balance sheet. So the definition of the current asset is anything which is going to be realized, i.e. converted into money by within 12 months from the end of this balance sheet. So this balance sheet is 2016. So let's say December 2016. So if these assets are account receivable which are can be recovered within 12 months, inventories if they can be sold within 12 months, if there are certain inventories which we know we will not be able to sell within 12 months, then we have to provide that information how much inventory is for more than 12 months. It will still be here or it will be go to the long term asset or also called non current assets. There are other category which is called non current assets, i.e. long term assets. They are intended to use for more than 12 months. So normally any asset which is held by the company is going to be show here. Normally there is there are accounting standards which governs the disclosure requirements of what we need to disclose in terms of balance sheet, in terms of property, non-current assets, what information we need to provide. That's a separate course, so we are not going to cover those things here. It's not required. Then the other side of the balance sheet is the liability side, which is also again divided into two parts. Liabilities are current liabilities, which you have to pay within 12 months from the balance sheet date, and there are long-term liabilities, which you don't have to pay within 12 months, which is for longer term. So maybe you have to pay them after 3 years or after 5 years. So that is the liabilities. And then apart from liabilities, you also have the stakeholders equity, the amount contributed by the owners. So if the company has not much of debt, then it will be only the small liabilities and majority will be the shareholders equity. But certain companies is the other way around. The majority come from the outside debt and the minority come from the shareholders. But the shareholders are the one who are enjoying the use of the assets. So every one of them is rewarded in one way or the other for the use of the asset. These assets are owned by the financiers. The financiers are shareholders and also the long-term debt providers. So they are all getting benefit out of the use of the asset. So the long-term debt get interest, right? Interest and the repayment of their money, and the shareholders get the balance of the profits. So and the risk is belong to the shareholders. Debt are not taking any risk into the operations, whether you make profit or you make loss. They don't care about that. They would care about the assets. So that's how you can read the balance sheet. Tangible assets are usually which one you can see and feel and touch, right? The intangible assets are those which are not visible to you. For example, the software license, correct? So what you are doing is you are paying for a right to use somebody's knowledge. Somebody who is knowledgeable has written a software and you are paying for it. For example, like Windows, you cannot see the window. I mean, yes, you can see the windows, but you don't own it. It's not physical unless it's on a CD, correct? So usually the computer softwares are intangible assets, which you cannot see actually, you cannot trade, you cannot touch them, you cannot feel them. Compared to the building where you can see the building, you can touch the building, you can feel it, you can go inside and stay there. But in terms of computer, you don't, right? For example, trademarks, for example, patents. If you have bought any patent or a right to use of anything, So those are called all intangible assets. For example, you have taken a land on a rent. So basically you don't own the land. So it will not be your tangible asset. It's not your asset, right? But you have a right to use this land for, let's say, next 50 years. So it becomes your intangible asset. So basically it's a right to use the land. Land does not belong to you, but the right to use it for next 50 years belongs to you. So that becomes an asset for the company. So those are called intangible assets. That's why we separate them into two separate parts, tangible and intangible, so that the users of the balance sheet, those who are reading the balance sheet, understands how much of the assets are actually right, basically intangible assets. Retained earnings are basically your profits. So the common stock or paid in surplus is their original amount of contribution, right? So they started the company with, let's say, $8 million, correct? But after that, they run the operation, they make a profit of 1 million. Then next year, they make another profit of 1 million. So the amount will be not added to their common stock because this is not what they paid. It will be added to the retained earnings. It belongs to them. They can take it back by in terms of like dividend, right? So the company can pay dividend, whatever profit you make, you can pay as a dividend to the shareholders. But instead of paying the dividend, the company has reinvested the money into the business itself. That's why it's called retained earnings. It's also a part of your financing basically. So you are using the company money to finance your assets, but it belongs to shareholders. In corporate finance, usually you use to understand the balance sheet normally will provide a very few ratios apart from the asset efficiency ratios. You usually use the market to book ratio. So what is the market value of the equity compared with the book value of the equity? So that's called market to book value ratio. It's also called price to book ratio. That usually will define how well we are able to increase the wealth of our shareholders. So let's say the company's book value is only about $22 million. That's what they have, right? 8 million they originally provide, 14 million they reinvested. Their total book value is only 22 million. But the company's market value may be much more because they, if you go and sell their shares in the market, they may be worth 100 millions. So that's we call a market to book ratio. So this one ratio is usually used to determine how well we have managed our investments or how well we are able to create the value by the company or increase the value of the shareholders. And also there is another term called enterprise value. So the enterprise value of the company is the market value of the equity plus the debt on and minus the cash. So that is called the enterprise value of the company. So we will be looking at these terms in the future. So if you want to calculate the market value of the asset, let's say the share price here is only $1. So there are 8 million shares, right? So, and the market value of the share is, let's say, $10 million. So what would be the enterprise value of this company? So how we calculate it is the market value of equity, which is 8 million times $10, which comes 80 million, right? Plus the value of debt. The value of debt here is $113 million. So we normally take the long-term debt only, not the short-term debt, only long-term debt. So 80 millions plus 110, it becomes 193 millions, right? Minus the cash which you already have holding. So minus cash. So minus 23 millions. So what will be the value? The value will be 90 plus 80. $170 million will be the enterprise value of this company. So that's how we normally define enterprise value of the company. Normally, the enterprise value is just only a measure to show what is the total value of assets of the company. When you are selling the company, you normally value the equity only because you are selling the ownership right. When you are selling the assets of the company, let's say you are selling all the entire business, correct? You are not going to sell the cash, so you will keep the cash, correct? But you are going to sell all the other assets, right? From account receivable until the long term assets. So how to value this? So the value of this company, basically these assets in the market, because this is only a book value. Remember, the accounting is only a historical thing. So you cannot sell at this price, right? Because this is book value only. So to sell these assets, you will normally need to know the enterprise value of the company, because you are selling the entire business. There are other things which are not recorded in this balance sheet. There is a goodwill, there is a company relationship, there is the ability of employees. Those all have a valuation, right? So the yardstick to measure the company's value usually is the share price of the company. So you look at the share price of the company, you multiply this by the number of equity shares. So that's the ownership, plus the debt, because the debt is also used in financing the assets, right? So plus the debt and minus the cash, because usually the market value take care of everything. So you have to remove the cash, because you are not going to sell the cash to the third party, right? You will keep the cash to yourself. So that becomes the value of the company, which in case you want to sell the entire company, you will use that amount to sell. Then you may ask, the share price of the company are keep coming up and down. So how you would define the value of the company, right? So one day the value of the enterprise value of the company is very high. Next day stock market crash. So the company's value is also going down, right? What happens in that case? In case you want to sell, what value you should use? So in that case, usually you don't really use the market value of the company based on the stock exchange, right? You define the market value by calculating the valuation of the company. So the valuation of the company is a separate thing, which we will be discussing in the next sessions very briefly, how we value the stock. So there are methods on how we can value of the stock based on certain principles. Stock market is also running on those principles. So ideally, the stock market price should be a good indicator of the company's value, but the share market is going up and down not only because of the company performance reasons, but also because of the outside reasons, which are not like in now. Coronavirus is spreading out, right? So market price of the companies are going down. It doesn't mean that their value is also going down, right? It just means that the mindset of the people, they don't value the investment, because certain people sell the shares out of fear, right? They may not look at the value, but they just want to keep the cash. There are many considerations when it comes to the stock market. So stock market is not always not a yardstick to measure the value of the company. There are other ratios which we have discussed in our other classes. I remember the fixed asset inventory, the turnover ratios. So those are not related with the corporate finance. So we are not really discussing those ratios here. Then there is another statement called the income statement. So the income statement usually lists the firm's revenue and expenses over a period of time, and also called P&L statement. Some are calling it P&L income statement, or whatever, however name you want, right? And the last line is the one of the income statement, shows the net income, which is going into the retained earnings. So that's the amount which will go into the retained earnings. Format of the income statement can be different for every company. Some companies show only the sales at first, and then the cost of sale, they calculate gross profit. Certain companies, they just put the net sales first and then every other expense into one, right? So they don't show the gross profit. But that's not the important. The important in this corporate finance class is this, the net income, which is going into the your retained earnings. The income statement will be defining you the net income, the cost of sale, how the company has run the gross profit, what are the other expenses. You are analyzing only from the perspective that how this can be better, or how this can be changed to give a better value to the company. So that's and then there is usually a line called earning per share, which is the net profit divided by the value of the number of shareholders, number of shares that are there in the market. And the diluted earning per share means the net profit, net income, divided by the other shares which are not yet issued but are going to be issued in the future, but are already committed. Sometimes is higher. I mean, the earning per share, diluted earning per share will be lower than earning per share, because there are always stock which you have committed to issue in the future but you have not issued. For example, employee stock options. So you have promised your employees that they will get certain number of shares, but you have not issued them because maybe there are certain terms and conditions which may have not fulfilled yet. So in order to provide a better information to the shareholders or the user of the financial statements, the law has required them to factor in those shares which are going to be issued in future to calculate a diluted earning per share. So when you are looking at any company's balance sheet or any company's income statement to understand how much they are earning per share, you should not be looking at earning per share. You should be looking at diluted earning per share, because that's what you will be getting in the future, right? So usually when we make a decision on our profit on our investment, usually we look at earning per share to understand how much price I have to pay for this. To take you a very simple example, the share price of this company is, let's say, $10, right? So it means if I spend $10 now, I will be earning 0.5 every year, right? So my return is what? 5%, correct? 5.3%. And if I look at earning gross total earning per share, it's 5.6%. So that's the difference. If my desired return rate is, let's say, 5.5%. So if I look at earning per share, this investment in this share is good. Means I should invest because I'm earning 5.6%. My required return is only 5.5%. I'm getting 0.1% extra. But in the future, in reality, my earnings are actually only 5.3, because there are other shares which are not yet issued, and maybe they will be issued in next year. So by the time I get to get the income of this share of this income, they will also be sharing. There will be more shareholders sharing the same income, right? So my return will reduce to 5.3%, which is not enough for me, right? Based on my criteria. So you always need to look at diluted earning per share, not at earning per share. And diluted earning per share will be calculating net income divided by existing shares plus any other commitments, right? So then the denominator will increase if there is any commitment. If there is no other commitment, earning per share and diluted earning per share will be the same. Okay, so normally the gross profit calculations are done like this. The gross profit is calculated by revenue minus cost of sales. From the gross profit, usually there will be earning before interest and taxes. So we have to minus the operating income and expenses, other income. So that becomes our EBIT. Then from EBIT, normally we adjust any non-operating income, but we don't deduct any interest, depreciation or taxes. So after we get the EBITDA, then we deduct the interest and depreciation to get a pre-tax income. After the pre-tax income, we minus the taxes to get the net income. So that's normal flow from the revenue to the net income. And then we calculate the diluted earning per share. So as I was explaining, diluted earning per share usually can be because of the stock options or because of the conversion, because maybe let's say you have taken a loan from a bank and you have committed to them that after 5 years the loan will be converted into share stocks at any price, whatever price is determined by them. So means you have committed to increase the shareholding of the company after certain number of times. So those all will be included in the calculation of diluted earning per share. Then you have a next statement called the statement of cash flows. So the statement of cash flows is usually will give you the information about the given a during period, about how much the cash has been generated and how the cash has been used, where the cash has been used, what we have used, what we have done with the cash, and how, if there is a shortfall, means we have invested more, how we have increased the cash. This is important because cash is required to pay the bills. Only profit is not enough, right? So the cash flow is divided into three categories: operating, investment, and financing activities. So operating activities usually are paying your suppliers, collecting from your debtors, managing buying and selling for your supplies, inventories, and everything else. So usually you will be looking at and paying your normal expenses, right? So there are two ways to calculate it. One is direct way and indirect way. In our previous class, I think I have explained this already, how to calculate in a different ways. So the direct method, basically you just have to recognize how much money you have actually collected from your customers, whether in cash sales or from your credit sales. So how much money you have actually collected. then you will put that as a cash income minus whatever you spend on either cash purchase or pay to your credit suppliers. That will be your cash expenses. And there are other usual operating expenses which you are paying in cash. So only the cash. If you have done the expense but you have actually not paid it, it will not come into the cash flow. And then you will summarize that into cash from operating activities. The other way of calculating, which is called the indirect way, which is a bit easier way to calculate, we normally take the net income from the profit and loss statement and we add any non-cash items in the profit and loss statement. So in this profit and loss statements, only non-cash item was the depreciation, the visible one, right? So we added that one into the business, and then we look at the balance sheet. And in the balance sheet, we look at what are the changes between the account receivable. If the account receivable are increasing, means we have not collected money from our customers, right? So we minus. And because in the profit and loss statement, we have already accumulated all the sales as cash because we have already taken the net income as a cash income. But if some money has not been collected because the account receivable, i.e. your customer balances are increasing, means you have not collected that amount. So you will minus that. If the account payable are also increasing, it means you have not paid to your suppliers because that's why they are increasing, right? So we will add it to the cash flow. And same goes for inventory. So all the current assets, if they are increasing, it means you have purchased something and you have not or you have spent the cash to buy the inventory, or you have not collected the cash from the assets. So you will reduce it. If the current liabilities are increasing, means you have not paid them the cash, so you will add into the cash flow, or the vice versa. If they are reducing, you will reduce for current liabilities. If current assets are reducing, you will add into the cash flow. So that's the general principle of direct and indirect method. So once you do that, you will be getting the cash from operating activities. Cash from operating activities basically will say how much cash has been generated only in this period. There is no other cash generated at the moment. So only from your general activities, from your operating activity, how much cash has been generated. Either is a plus or is a minus. So if it's a continuous minus, usually you have to be worried. The managers have to be worried that because it seems like business is not sustainable enough, you are not able to generate enough cash for your own survival, means you are taking money to run your normal operations, right? If in, for example, in this case it's minus 0.4. If it's consistent, if it's like 3 year 4 year is consistently minus, then it's a problem. Otherwise it's okay. Then you have to look at the investment and financing activities. So financing activities usually will tell you how have we raised any money in this period, whether from the long term borrowing or short term borrowing, or we have paid any interest or we have paid any dividend. Net amount will be your cash from financing activities, and how we use that money, we will look at the cash from investing activity, which means if we have purchased any fixed asset, we have sold any fixed asset, we have invested money into another company or on a stock exchange, or whatever we have done. So we will look at that. For example, here in this case, the company has purchased capital assets of $33 million, and that $33 million came from long-term borrowing of the company. So if you see on any cash flow, the investing activities are not happening for a consistent period of time, it means that company is not growing into anything, right? Because they are not doing any investing activities. So in order to grow its income potentials, company need to grow and they have to increase their assets. Otherwise they will not be able to grow in the future. Existing asset will demolish very soon. If you are not investing into new assets, means company has not much of future. So this is one way of looking at it. So the money, where the money will be coming from, money will be coming from either from the investment from the owners itself, so means additional raise of the money, or there will be some short term borrowing or long term borrowings. The only thing that you can check is how much money that you are paying, like what is the rate of interest that you are paying here for borrowing, and what is the return on your assets. So there your ratio analysis comes into picture. to understand what is the return on assets. Whatever investment I'm making here in terms of capital expenditure, am I earning enough money in order to sustain the additional interest expenses that is we are incurring, right? Because you are incurring the borrowing means you are paying for the interest. So is it enough or not enough? So that is something you have to analyze in order to ensure that the company's investment decisions are worthwhile. In hotel industry is different, right? And it's different for managers and operators. So let's say there's a company who is managing your hotel, right? So in order to protect the owner's interest, normally there is a cap that, okay, out of whatever profits we are generating, we will be spending only a X amount on the reinvestment of the capital, right? But other industries, it does not happen like this. Or when the owners are deciding, they may not decide that, okay, like there are renovations, right? There are major renovations every year where you can say, okay, this does not apply to the major renovation. There is no cap on the percentage to EBITDA. Let's say the hotel has been 10-year-old and you have to renovate the hotel. So they are not limiting by 2% or 5% of profits in order to determine how much we should be spending. So the similar way, the businesses, when they see a project which is going to grow their income potential, they are not limiting themselves by the profit they have earned, right? Otherwise they will not be able to grow fast, correct? So what they see is whether this project that they are going to invest or they are going to invest the money in will be generating enough income to substantiate the additional money that they are investing, whether they are investing from their own pocket or they are investing from the bank. So they normally have to see what will be the return potential from this particular investment. Let's say you are able to borrow at 10% from the bank, correct? So any investment which is going to generate more than 10%, you will be happy to take, correct? Let's say there is a building which is giving you 11% rental. So you can always tell the bank, okay, give me the money $100 million at 10%. I go and invest that $100 million into this particular building, which is going to give me an interest of 11%, right? So I save 1% extra for my company, right? That way we make the decisions. But if let's say the bank is not giving me the loan, it's the shareholders' income, then the shareholders will see what are the two projects that I'm doing. Let's say I keep the money in the bank, I earn 8% only, and there is another project where I can spend the money and I'm able to earn 9%. Is it worthwhile for me to take the risk or not? Because the putting the money into bank is risk free. There is no risk of loss. But putting the money into a business is a risk. So whether the extra money that I'm going to get is worth my risk or not. So we will be looking at those criterias in the future, how we factor those risk into the things. But the cash flow will help us to understand how the business has generated the money and where they have actually invested it. So if you are a finance manager or an analyst who want to, let's say, buy this company, you will make a question that, okay, if you have invested in capital expenditure, what is the logic? How much you are going to earn and how much you are going to pay on the long term borrowing, just to evaluate whether this decision was good enough or not, or whether this will increase the shareholders return. In certain companies, they have no limit. Any amount which you are spending, even $10, if it's qualified to be a fixed asset, means it has life of more than a year and it's gonna be used for the revenue generation in the future is a possibility, right? So it will be qualified as an asset. So there's no amount limitation on that, say. But certain companies, like big companies, in order to reduce their administrative burden, because if you keep on recording everything into fixed asset, you need to go and verify it. Also you need to keep the main register, then you have to have a documentation for selling it, buying it, transferring it to somewhere, right? So there are quite an administrative task related with the fixed assets. So in order to reduce those tasks, the companies come up with their policies that, okay, up to $500 we are not going to recognize anything as fixed asset. So whatever you are buying, even if it falls under the technical definition of fixed asset, we will not recognize. We will just charge it to the expense. so that we don't have to worry about the future counting and losses and all those kind of things. Or normally the operating activity for cash flow is the account receivable, which normally we adjust the cash flow by increasing the account receivable. So any increase normally represent that the company has lended some amount to its customers. They have not collected. It means that we are reducing our operating cash flows. It's other way for the account receivable. If it increase, we add increased in the account payable to the cash flow, because it means we are using their money now. Inventory is going to be treated same as the account receivable because this is on asset side, and the other way around. So there are non-cash items such as depreciation, provision for retirement, provision for tax and other things. So these are the operating activities in the cash flow, which we have already discussed. Then the investment and financing activities usually are subtract the capital expenditure that the firm has made. Also the other assets that you have or other investment that we have made, such as acquisitions, buying of the shares or anything. And if we sell this, then it will also be called as investing activities. Financing activity is usually the dividend paid, the interest paid, or any loan that you have taken for on behalf of the company, or any repayment. So any activity done for the long-term debt and equity is going to be recorded in financing activity, whether you raise the money or you return the money in terms of dividend or interest as well. And anything has to do with the fixed assets, i.e. the long-term investments, capital expenses, the fixed assets, all has to go into the investing activity, and the rest will be operating activities. Okay, then there is another financial statement, usually the statement of changes in the shareholder equity or the comprehensive income statement, management discussion and analysis, and notes to the financial statement, which are also just the same thing but detailing the information which is already there in the balance sheet and also the income statements. For example, notes to financial statement are going to describe the policies, what we are following, what kind of depreciation rate we follow, what kind of life we follow for the asset. As you were asking, does they have a policy of recognizing everything as a fixed asset, or there is a cap or minimum amount to be qualify a fixed asset? So they will be defining these policies into the notes of account so that users really understand what the company is doing and how they are making up these financial statements. So the way of doing the financial statement analysis is to compare the firms by itself first, analyzing how they have changed over a period of time, or comparing with the budget, right? Normally every company has budgets, they have forecast, and they compare their performance against the budget and forecast and also the previous year, right? In terms of both absolute number and also the ratio analysis. And also the company need to compare themselves against their competitors which are of similar size and in similar type of operations. And we normally the comparison is done through the ratios. Normally with the competitors we don't really compare the amounts because the size of the company is not exactly the same and the business models are not exactly the same as well. So normally we compare only the ratios, not the absolute amounts. So the key ratios which we use in profit and loss statement are going to be the profitability ratios, the gross margin. So we will not be doing the physical exercise here because otherwise we will not be able to focus on other time. You can look at the formulas here and you can try this exercise at home with the numbers that are given in the previous slides. So, and you can attempt to do it by yourself. If you have any question, you can always ask me. Then you have operating margin, how much a company have earned before interest and taxes, net profit margin. So these are the profitability margin. They just give you information that the company's operations are profitable or not. That's it. There's nothing yet said that whether they are good enough or not, right? Because we are not comparing them against the investment. We are just comparing whether we operate, we sell and purchase, we have made any profit or we have not made any profit. But whether is enough for the shareholders, that we can know only when we compare against the investments, our assets. So those ratios will be also coming in. We will just discuss them in a little bit. Then there are liquidity ratios. which are current assets. These are just tell us that the company is liquid or not. The company has enough money to meet its financial obligations or not, right? The current asset divided by current liabilities. If it's more than 1, it's good. If it's less than 1, it means the company's assets are not sufficient to pay the current liabilities. So this is quite a risky thing for the company, that it may not even be able to meet its short-term obligations. And there are quick ratios: current assets minus inventory divided by current liabilities. So what is the difference between the quick current ratio and quick ratio? Because the current assets include your inventory, your account receivables, your customers, and also the cash in hand, right? So inventory is not readily changeable to cash. If let's say tomorrow supplier come and ask the money, you cannot give them the inventory, right? Because you have to sell the inventory first. And when you have to sell the inventory, there may be normally a time between before you are able to sell the inventory and able to collect the money into cash. So usually we calculate a quick ratio, which is current assets minus inventory divided by current liabilities. And then there is a cash ratio, just only the cash. How much cash is we have available against the current liabilities. So it doesn't have to be 1. You don't always have to keep enough cash just to meet all the liabilities. So it will never be 1. If you are keeping like this, then you are actually wasting the cash in the company. So you don't have to keep the cash enough to meet the current liabilities, but it should be certain amount. Let's say 0.3 or 30% of the current liabilities or 40% of the current liabilities, you are keeping it a cash. So the financial managers, they will need to decide how much cash ratio they are going to target, right? The job of financial managers is also to understand what should be their current ratio, what should be their cash ratio. Because the cash, whatever cash you are keeping in your hand, is going to be not invested into business. And when you're not investing the money into the business, you are not growing your income potential, right? So it will reduce the value of shareholders. The financial managers has to analyze and how much should be the ratio, and then they calculate the actual ratio against their standard. So every ratio, finance managers need to put a benchmark, their own benchmark. How much it should be? How much should be my profitability ratio? How much should be my liquidity ratios? How much should be my current asset ratio? So that their actual performance can be measured against it. Then you have the asset turnover. How much sales I am able to make against the assets. So this asset efficiency ratio is just to ensure that whatever assets you have created in the business and you are using is efficiently used. How much sale you are able to generate from your total assets. Normally you can compare this against your competitors to see, are you able to use your asset efficiently compared to your competitors or not? If not, what's wrong? What's the problem? Or against your previous year efforts, if your asset turnover has increased or not, right? If it has increased, it's good. If it's not increased, means you are not using your assets in the same efficiency as you might have been. So assets include the, as we said in the previous time, fixed asset may also include the investment, may also include construction in progress, or any items that you may not have actually used or actually used in the business operation. So another turnover ratio for that method, fixed asset, which is usually involved only in selling, direct revenue generating activities. So that is called fixed asset turnover ratio for production facilities. For service, this ratio may not make any sense because your sales is not dependent on your assets, right? For service industries, sales dependent is on what? Sales is dependent on number of peoples that they have in the company, right? So instead of using the fixed asset, they will say sales to employees. How many peoples are there to generate that part of sale? How much sale is there per person? So that would be more relevant ratio for them. Then you have the working capital ratio. Are you able to collect your money in time or not from the customers? So that is a very key ratio for, especially nowadays when the companies are tight on their cash flow. Are you able to collect your money in time from your customers? And how does it compare with your competitors? Is it enough? Is it faster or is it slower? If it's faster, means you may be losing an opportunity of sale. The customer may buy from the competitor because they are giving better credits, while you, if you're collecting slower, it means that you may be losing the cash generating activity. It depends on what is your sales, right? Are you getting a higher market share or not because of this? So you have to really evaluate. Then you have inventory turnover ratio. How many times you are able to sell your inventory? Anything more than the previous time is better, right? Because then you are able to turn your inventory faster. So here is an example. So you may want to calculate the ratios here. Okay, so what do you do with this information? This information in itself is useless because it's just a number, right? So you have to compare this against with the previous year, whether your account receivable days are increasing or decreasing, or whether the competitors are having a better rate than you or not, right? And what is the industry benchmark? Are you within your industry benchmark or not? So these are the things that you have to really consider. Then usually there are some other ratios which are important for finance managers, is also called interest coverage ratio. So what is the interest coverage ratio? Some companies have pay the interest, right? So what the finance managers want to know is how much I'm earning compared to the interest that I'm paying. So the very simple formula to calculate is earnings divided by the interest. The total earnings before interest, depreciation and taxes, no, not the net income. Earnings means before the interest, divide by the interest itself. So usually you will use EBITDA for calculations. So the simple calculation is simple. If it's more than 1, it means the company is able to earn enough to pay their interest expenses. If it's less, then it's a problem, because then it means that the company's operations are not even to pay their interest expenses. Then the bank will also put the company in risk and it will not be able to provide any future expenses. And also the bank will be calculating how much you are earning at the moment and how much money you have requested. Based on that, they will try to assess what would be your interest coverage ratio. Will your current income or projected income is going to be able to pay the interest or not? If not, they will not process the loan, right? So that's how the scenario works. So here is again an example in our original balance sheet. If you want to calculate the EBIT ratio, so we can gather the information. So the EBIT is 7.1 and EBITDA is 10.4. So you can calculate the 2015 and 2016 interest coverage ratio as 1.54, 1.35, and based on EBITDA is 1.78 and 1.51. So it's still higher than the interest, is more than 1. It means the company is at least is able to pay the interest in both the years. Their earning is enough, right? Then you have the leverage ratios. So how much you have borrowed compared to what you have contributed by yourself. These ratios normally tell the financiers how much skin you have in your own company, right? So if this ratio is very low, the risk in the company's performance is increasing, because there is a too much debt and too less of equity, means the interest of the debtors is going to increase in the company, and the equity shareholders may not be able to justice the expectations from the financiers. So anything more than 2 going to be considered as risky. The 2 is a global average, but it depends on the industry to industry. For example, in manufacturing industries, it can be more than 2, but in like tech companies, it's never more than 1 or even 0.1 or 0.2, because the tech companies are not required to take that much of loan. Normally they invest by themselves, right? So that's how the ratio works. So you have to look at your competitors and the industry average in order to understand whether we are taking too much debt or too less debt. Taking a debt increase the shareholders return, because usually the companies earn higher on their assets, higher than the normal market interest. So for example, let's say a company who is hiring 10% return on the amount they have invested, right, on their investment, and the bank is giving at 5%. So what the company can do, they can take all the money at the from the bank and put into the investment, and very little amount of themselves. So all whatever they are earning is coming to them as a pure income. So their dividend keep on increasing, right? Without investing anything, without investing their own money. But what will happen is the debt equity ratio will continue to increase. and it will increase at certain point that the bank will be forced to increase the rate of interest, which means your projects in the future will have to be either supporting you the higher income. Otherwise, the bank is not going to be justifiable for you to look at the interest. So we will look at the application of this ratio in the future slides. So, but for the time being, just know that this is one of the important leverage ratio that we are going to be using. Total debt divided by the total equity. And then there is a debt to capital ratios. Normally, the total debt divided by the total capital employed in the company. So normally it has to be around 0.67, not more than 0.67. Okay, then there is a debt to enterprise value ratio. There, so every different finance companies and finance managers use different ratios, but the idea is going to be remain the same. Then you have some valuation ratios that are used in the corporate finance, which we have not learned in the previous class. The valuation ratio normally is to understand the what is the share value of the company. So the one of the important ratio is the firm's price earning ratio. So the price earning ratio basically is the market capitalization divided by the earning net income of the company itself. What is their price to earning ratio, or share price divided by the earning per share. So here earning per share, or you can use diluted earning per share, right? So that's the formula. So higher PE ratio means the higher is the valuation potential of this company, right? So whenever sometimes we are investing on stock exchange, we look at the PE ratio, price earning ratio. If price earning ratio is low compared to the industry average, which means that the valuation potential of this company is great, right? Because the price can increase to the industry average. It may be because of some short term sensitive information that the price is lower, but obviously before you invest, you have to be careful and look at the future potential of the business. So in the past, a lot of small investors use the PE ratio to justify their investment into companies. So they look at the PE ratios of different companies, and wherever they see that there is any company which with a very low PE ratio, they would go and invest into that company, whether the company has any future or not, right? So before you invest based on the PE ratio, you need to be careful and look at the future potential of the business. What is the future prospects? PE ratio is because, as you can see, is calculated based on, at the moment the formula is calculated based on the past, right? But there are PE ratios which are calculated based on the future income as well. So earning per share divide by the earning per share of next 2 years or next 5 years, which the company is giving you the estimated potential. So the experts are calculating what would be the earning per share next year, what would be the earning per share after 2 years, and then they will say, okay, earning price, the PE ratio is based on, and it's normally called multiples, right? So if let's say we are talking about PE ratio, we will say the PE ratio is 6, multiple of 6 compared to the last year income, or 5 compared to the 2022 income, 5 compared to 2025 income. So that those ratios are helping the investors to think whether they should invest in this company or whether they should not invest in this company, because they can calculate the valuation potential by themselves. So you look at the market to book value ratio also, just to see whether the market value is more than the book value or less than the book value. So normally there are companies where their market price fall below their book values, which means that if let's say you sell off all the assets of the company, you get more than what you have invested, right? So usually people look at that ratio. Then they also look at the future income potential of the company, future plans, the orders on their history. So that information is not really public. The big investors, the institutional investors, are researching on these companies, and they dig out the information by asking the companies directly. By the way, the PE ratio can also be calculated like a ratio to other factors, like not only the net income, can be to sales, market capitalization to sales. Especially in the startups, they are using multiple methods of calculating the market value, especially the enterprise value. So here is, we are also calculating the enterprise value to operating income and sales. So we need to calculate the enterprise value first, which is market cap plus the debt minus the cash. So for Walmart, enterprise value will be 222 plus 54, 276 minus 8, 68, right? So these are the formulas. So enterprise value divided by operating income, enterprise value divided by sales. PE ratio is market cap divided by the net income. So here you can calculate Walmart has an operating income of 6%, a net margin of 3.6%, 17 divided by 65, and the PE ratio is 13. Its enterprise ratio is 9.6 and 0.57, while target is 6.8% and a net profit margin of 4%. So it's better than Walmart. PE ratio, however, is lower than Walmart. So PE ratio for Walmart is 13 and PE ratio for Target is only 12.7. And their enterprise value is 55B, and compared to operating income is 11, compared to Walmart, which is 11, 9.6, is higher, and the ratio to sales is also higher, 0.75 compared to 0.57. The Target has a higher value for their enterprise value. Their PE ratio, the market capitalization ratio, is lower than Walmart, right? So the reason there is primarily the debt. So the debt in both the company, if you look at the ratio of debt to the market capitalization, the debt is higher compared to a higher percentage in Target compared to the Walmart. So that's why their PE ratio is lower, but their enterprise value is higher. So PE ratio itself is not the justification for your investment. You need to look at the enterprise value as well. PE ratio is basically what we are trying to calculate. The price to earnings is how much is the value of company compared to our earnings. There are two ways you can calculate this. Market capitalization means the total market value of shares, whatever shares are outstanding in the company. Any famous company called, let's say, Apple, right? Apple may have millions of shares outstanding at the moment, which are held by individual investors. So what we will do is today we will look at the Apple's share value. We will multiply with all the shares in the market, and then we will get the market capitalization of the share. So you might have heard Apple is now valued at 100B or $1 trillion, right? $1 trillion company. So what they do is basically they look at what are the total number of shares which are issued by Apple, compare with the market value of the market share of the value. And then that 1 trillion, which is coming up by the market capitalization, we will look at their net income every day, every year net income, and then we will come up with the PE ratio. So that is called price to earning, or what is their market capitalization compared to their net income. It's usually much higher and in the range of less than 10 for most of the companies. Why? Because the investors are always investing in the company where the PE ratio is less than, let's say it's only 1. It means it's only 1%, right? So let's say the market value is 100 and the earning is only 1. So if the PE ratio is 100, means it's very high, right? So nobody is going to invest more into this company. Nobody want only 1% income, correct? But if let's say it's 10, the market value is 10 and net income you are getting 1, so means you are getting 10% income. So whoever who is earning less than that will be definitely switching their shares, their demand to that particular share and say, okay, I want more of this, correct? So because of the normal supply demand price logic, wherever there is a demand there is an increase in the price, right? So the market price of that share will keep on increasing until the time that it reach to a destination where nobody else want to invest into this share, right? So let's say the market interest rate is 5%. So the actual PE ratio, so what should be the market price of the share based on $1? It should be 20 based on 5% normal return. So the maximum price for anybody would pay for this Apple is $20. So if it's less than that, the peoples are going to buy and put more pressure on the price because there is a lot of demand. and more, and the time it reached 20, it will, the people will stop losing, people will lose the interest and say, okay, I'm not interested in this share anymore because I'm getting 5% outside, 5% in this share, so no big deal, right? But then another variation of the PE ratio is the PE ratio compared to the future income. So let's say the Apple, we say that it grow by 10%, and another company, let's say Amazon, is going to grow by 5%. Both have the same income. So PE ratio normally we calculate based on the current income and also based on the future income, so that we understand what is the future potential of this company. Then the finally comes the returns. So the return ratio basically is the, until now, let's say the margin ratio. Margin ratio has not much of meaning for finance managers because it just tell us that what is my operating margin. Even though operating margin can be low, but the return ratio can be higher. The company can be more profitable or more valuable even if their return ratios are less than the other competitors. And the reason being, it depends is because how much actual return they are able to generate when compared to the book value. If the operating margin of company is very high, it will be highly valuable, or there can be cases where the operating margin is low, but because the return on the investment is high, there will be more valuable, right? So the operating margin does not define the value of the company. It's the return ratio, operating return ratio, return on equity ratios, which are more important, right? Because it depends on how much you have invested into the company and what is the real value you are earning, not the operating margin, the actual income, right? So your net income may be very high, correct, but the operating margin may be low. So you would invest into a company who has lower in operating margin but higher return on equity, or you would invest into a company who has lower return on equity but higher operating margin. Which one? Higher return on investment, right? Even though they may have a lower operating margin, you will still choose the company which has a higher return on equity, higher return on investment, right? Because what is important is not the operating margin, what is important is the return on investment, because that's the goal of the finance manager, to maximize, right? But you can always look at, and you can always say as the operator and say, okay, if the operating margin is low, if I am the owner of the business, I will try to make it higher by reducing the cost or increasing the price or do whatever it needs to be done so that the return on equity is maximized, right? Then the other return ratio that is normally important is the return on assets. So there is return on equity and this is return on asset. Return on equity and the net income remains the same for both, right? Net income is the same. So when you are calculating net income divided by equity, which is less, return on equity will be shown as a higher value. While return on asset is going to be, the return on equity is good for theoretical analysis of the financial statement, but it has no practical implication because it's one is calculated on book value of equity, and book value of equity is not relevant because it's past, right? What is more relevant is the current value of equity, because if let's say you are investing into the business as a new investor, you will not look at the book value, you will look at the market value, right? So we normally calculate the return on equity in a different manner on a market value, but for the classroom academically, we calculate the book values. There is another formula called return on invested capital. So total capital invested. So the return on fixed assets is return on asset, and return on invested capital is different because here we are calculating net income, right? Or return on assets, but the net total asset are actually generating a rate income which is higher than the net income, right? That because the total assets are coming from the shareholders and also coming from the debt holders, right? So the total assets are able to generate is higher. And what is the difference? The higher is the earning before interest but after the taxes. So what normally we look at is we calculate earning before interest, taxes, and then 1 minus the tax rate. So what we are calculating here basically is earnings before the interest and the taxes. But after the taxes. So earning before the interest, but after the taxes. And we divide that by the book value of equity, I mean the amount invested into the business plus the debt. How much is by net debt? Net debt normally is, the formula for net debt was debt minus the cash, basically the enterprise value, right? So that is the formula for calculating return on invested capital. The book value of EBIT, earning before interest, minus the tax, divide by book value of equity plus the net debt. This formula is more relevant compared to return on asset. Reason being, it's calculated on the entire income of the company, which is distributed to equity shareholders and also distributed to the net debt holders. Let me try and simplify this, right? Let's say Omar and Mr. Day are partners, and Mr. Day has invested $10,000 into the business and Omar has invested $5,000 in the business, correct? And you guys are together and doing the business. So the total investment into the company is $15,000, right? But there is the catch. Omar says, Mr. Day, whatever you want to do with this $15,000 is up to you. You need to give me $500 fix my interest, 10% interest. Now, let's say Mr. Day has run the business, or both of them has run the business. And at the end of the day, the total income of the company is $2,000. So what you will do? So $2,000, let's say is after the taxes, right? But before you pay to Omar, now $2,000 is going to be distributed into two parties. One is going to be Mr. Omar. Omar will be get how much? 500, right? Because he asked for fixed amount. So he get 500. So the balance 1,500 goes as a net income to Mr. Day, correct? So now if you follow this formula, right? Return on equity. So Mr. Day's amount is considered as book value of equity. So what will be the return on equity? 1,500 divided by 10,000. Return on equity of the business is 15%, correct? Now the total assets are 15,000, right? So let's say there is no other debt, just only total 15,000. 1,500 divided by 15,000 becomes 10%. And that 10% is getting, so Omar will say, okay, my return on equity is actually 10%. Return on total asset is 10%. I'm getting 10%. So I'm happy. Okay, so the return of the business is 13.3%. So how come Mr. Day is getting 15%, right? It's because Mr. Omar is getting only 10%, right? And since Omar is getting only 10%, the balance amount is going to Mr. Day. That's why his return is increased to 15%, right? So now you can compare this analogy into the comparison that the total business is total business. Mr. Omar is a debt holder. So he's providing only the debt. He's not interested into the business, right? He's not taking any risk. That's why he's getting a lower income. And Mr. Day is an equity shareholder, right? So he is getting a higher income because the business is generating more than what they are paying to their debt holder. So return on assets is practically 13%, right? And so this is that ratio. Return on invested capital is 13.3% that you have calculated. Return on equity is 15% that we calculated earlier. This ratio has no relevance because this is what we calculated was 10%, right? It's actually not the real ratio, correct? So you should not be using this ratio in making capital investment decisions basically, right? So this is just only a theoretical ratio from accounting perspective, not from the finance perspective. So that is the difference. So whenever your debt return, I mean the interest return that you have to pay to your debt shareholder is lower than return on invested capital, which is this one, return on equity will be always higher. But in case you are paying higher return, let's say Omar want to get 20% now, not 10% anymore, right? So who is taking the risk? So Omar can decide, okay, I want to take the risk. So he will get 13%. If Omar want to say, no, I'm okay with the 10%, I don't take any risk, but I get my fixed amount. So he will get less money. you will be ready to take the lower income, lower return that you are getting in a normal scenario. So then only you will be able to get a higher income. And because they are not interested in your business, they just want to get their money. That's it, finish, right? So they are not taking any risk. That's why they are getting very less interest. But if they get interested into the business, means they are ready to take the interest, then they will demand for the equal return, right? Which is basically the shareholders. So normally banks will look at the business potential. They will negotiate and say, okay, I give you $5 million now. After 5 years, I have a right to convert this into a equity shareholder. Because they are giving a significant amount of money, they may say that, okay, after 5 years, I have a choice whether I get my money back, or I will say that this is my equity contribution. So from the next time, I will not get my fixed amount. I will get the return on the equity. Means I should be getting my equal share of investment. Correct? This concept is very, very important for you to understand how the risk is going to impact the returns of the company, right? So let's, like for example, Omar said, now if I want the higher return, I need to be ready to take the risk. So if you're not taking the risk, you get a lower income. If you are ready to take the risk, you get a higher income. So the DuPont identity basically is just to break down the return on equity. So return on equity basically is net income divided by total equity, right? But the DuPont was company, they disaggregate this one ratio into 5-step ratio, right? So they said, okay, since return on equity is net income divided by equity, which is also equal if you multiply by sales divided by sales, it can also be derived into net income divided by sales and sales divided by total equity, means the equity turnover. And then it can further be multiplied by the asset. So it can be divided into three main parts, right? One is the net income divided by total sales divided by total assets, and total assets divided by the total equity. So if you remember, what was this? This was operating margin, right? Profit margin. So this they called as operating efficiency. How well we are able to sell and retain the profit out of sales, right? So that is the one aspect of business. The other aspect of the business is how much sale I'm able to generate from my total assets. So if you remember this formula is sales turnover ratio. How well I'm able to use my resources to generate the sales, correct? And then the another aspect of the business is financing of business, means the equity multiplier. How many resources I'm able to create by having an investment. So the net income divided by equity is turned into three aspects of the business. So there are three major aspects. The first one is, if I invest $10, how many assets do I have? Higher number of assets means you are able to use more, means you are not using your own money only, you are using the debtors money, outside money, to create more and more resources, right? The more and more resources ultimately should be able to generate more and more sales. The more and more sales should be able to generate more and more income as well, correct? So that was the idea of the DuPont analysis. They divide the one simple ratio, ROE, return on equity, into three separate parts to understand the various efficiency by different peoples. So who is responsible for income is the operations, right? The operation people are responsible for creating the profit out of the sales, correct? And who is responsible for generating more and more sales out of the total resources? Also the operations, right? And who is responsible to generate more and more resources out of equity? The finance manager, right? The finance guy is responsible to buy more and more assets with the limited resources of equity shareholders, means buy from outside or on credit or on the from the shareholders, right? And then the CEO is responsible to generate more and more sales using these resources, correct? And the operation team is responsible to keep the maximum profit out of the sales. So this is called operational efficiency, this is called asset utilization efficiency, and this is called the financing efficiency. So the formula of return on equity is profit percentage multiply by asset turnover multiply by equity multiplier, and this is the ratio. So can you calculate return on equity in both the cases? How much is it? Equity multiplier is higher. What is the equity multiplier? Equity multiplier was the asset that they created out of equity, right? So if they invest $1, they have $4 worth of assets, while Walmart has only 2.7, right? So one thing they have is the higher number of assets compared to the equity they invested into the business. But their asset turnover is lower than Walmart. It means they are not able to use their assets as well as Walmart is doing. But their profit margin is higher than Walmart. So it means whatever sale they generate, they are able to retain more compared to Walmart, right? If let's say the Nordstrom say, okay, we want to retain as efficient as Walmart, right? Means in terms of asset efficiency, we become 2.3, which is similar to Walmart or beat Walmart. So then we can increase our equity return, right? Correct. So what would be their equity return if their asset turnover is same as Walmart or beat Walmart? Let's say 2.3. How much would be their return on equity? So their return on equity will increase from 38 to 54 by just saying that let's focus on one thing, increase the asset utilization. That's it. So they don't need to look at the profit margin. They don't need to look at increasing more assets compared to the equity. They just need to make sure whatever assets they have, they are able to use them similar to what Walmart is doing. So this way, the DuPont analysis, you can focus your attention where you should be focusing. Now, the Walmart, let's say Walmart is saying that, oh, I am getting only 23%, Nordstrom is getting 38%. How can I reach 38%? What should I do? So now there are two ways. They are doing asset utilization better than them, right? So the way only better they can do better than them is two ways. One is increase the profit margin or increase the equity multiplier. Increasing equity multiplier is not easy because it means you are buying more asset, correct, on loan. But if you don't already have the competition, and you already have so many assets, you may not be able to do that in a short term. So the way to do it is increase the profit margin. So let's say how much profit margin they should be able to do if they want to increase their return to 38%, same as Nordstrom. How much should be their profit margin? Assume profit margin is X, multiply by asset turnover into 2.3, multiply by equity turnover 2.7, and then you divide the result from 38 point whatever percent is it, right? 38 divide by 2.3 divide by 2.7, increase the profit margin to 6%. So if you are owner of the Walmart, you would tell your CEO that, hey, or your budget for next year would be 6% of profit margin, right? So you will look at how you can do it, either increase the price or reduce the cost or do whatever, but make my profit margin to 6%. So this is one way of doing things. So this is how we normally plan for the better equity returns and set up the targets for the coming years. So it's 6.2%. Correct. Same problem again. So we don't need to recalculate again, basically. So just a summary. Here are some of the standard ratios that are in S&P 500 in US. But this is old data, it's 2016 data, so may not be relevant anymore. But if you want, you can look at the latest version of the book for the industry standards. So these are profitability ratio. Generally, manufacturing has a higher profitability ratio compared to the retail, but service has much higher, obviously, because service has less expenses, right? But the overall industry average is 39%. Operating margin, net profit percentage ratio is similar everywhere, is 2.5%, 2.6%, 1.3%. S&P 500 only is 4.5%. Then you have current ratios. Global average is around 2 for current ratio, and for cash ratio is about 0.7. For retail is different because it's less. Then you have working capital ratio. Average account receivable days goes up to 60, but very low for retail because normally they buy cash. And fixed asset turnover ratio is around 4.8. Then you have the total asset turnover, inventory turnover of 5.7. Interest coverage ratio on an average is 3.9 based on EBIT, and based on EBITDA is 6.7%. Right? Leverage ratio, Book to equity ratio, you can say now total debt divided by the total value of equity on an average is 46%. So the companies are not borrowing more than their own equity, right? So this is how you can see. So you have the ratios and you have the standards, so you can use them as a reference.